3, 2, 1. Welcome to the show, everybody.
I feel like we should be doing this live, bro, for the first time in quite a while. It's Sunday afternoon.
We're actually doing it on a Sunday.
We almost could be doing this live.
We had one of my favorite holidays on Friday.
Yes, indeed. Mine too.
St. Patrick's Day.
I didn't get to watch the Ireland-England rugby game.
I was watching it on my phone.
Yeah, no, I didn't.
And then I had birthday weekend for my little girl, youngest girl, and everything we had a busy weekend, so we decided to do this on a Sunday afternoon, which is really rare for us. We usually have done it by Friday or Saturday.
Yeah.
So anyway,
this is actually a good thing.
You're getting it last minute.
Yeah, and last minute is good because there's so much stuff that's gone on in the last couple days. Really the last 2 weeks. And our first real slide about this is kind of going to do a summary of all that. And it is a crazy time to be an investor at all. It sort of makes it a little bit easier in TSP because since we have the 2 move a month rule and the noon rule, if you're trying to play these ups and downs in this kind of crazy market, I mean, good on you. But there's an idea that's called swing trading. Mm-hmm. You might be able to buy a dip and let it run for a day or two and then get out, but then you're done for the month. So,
yeah, it's tough to swing trade in the TSP.
Yeah,
it's really tough. But
in this environment, I mean, it's rocketing up and down. And it's not just the stock funds; it's the F fund too. So, the only safe harbor is the G fund at this point. It's unless you want to be in it and try to anticipate these moves with the noon rule and the 2 month.
Go for it. Tell us how it works.
I'm not doing that.
Give us an AAR when you're done.
Yeah. I mean, I thought about the F fund. We're going to talk about the F fund, but it's the most probably important fund right now. I think you could make an argument that it is the most likely to move the highest. Not for sure, but I think the F fund is the fund I'm watching most right now.
Most likely to succeed.
Yes, most likely to succeed. Is that a high school thing? You get the gold star for most likely to succeed?
You write it in the yearbook, most likely to succeed. Right now, F fund, you are most likely to succeed.
It doesn't happen very often, but right now it is lined up to be the one most likely to succeed. We'll talk about that a little bit. All right, so TSP podcast, 19 March 2023. So we're going to take a summary of the past 10 days. I feel like I'm in a time warp, honestly, but we're gonna do a chart or a listing of all at least what I've been able to list as the most important things in the past about roughly 10 days. Then we're going to flip to the normal stuff. We'll take a look at trend lines and how to use them, relative strength, how to use that, and then we're going to combine relative strength and trend lines to see how you can really use it to pick the tops and bottoms. We're going to do, last week we looked at a chart of the short-term S&P 500. I'm going to compare last week's chart to this week. And I had a special request to do a bonus chart of the TLT. So we'll take a look at that. And then the weekly TSP fund charts. All right. So I spent all day.
There's a lot going on this.
There's a lot there, yeah. I spent all day yesterday, Saturday, it was online, the Wealthion conference. So Wealthion YouTube channel, it's wealthion.com, Wealthion YouTube channel. I talk about it a lot on Facebook, and it's an unbelievable wealth of information. And every year they do an online conference and an in-person conference. And the online conference was yesterday, and they had a whole lot of really good speakers on there. Wealthion tends to be a little bit on the gloomy side. Given right now there's not a whole lot to be optimistic about anyway, but they have unbelievably well-educated, connected people.
Yeah, they got a lot of smart folks.
Yeah.
And they're definitely worth listening to.
Yeah. Now, I spent 10 o'clock or 10 a.m. to basically 10 p.m. yesterday doing it, so my brain is like fried. And it was all really current and relevant. And so let me just go through what we're looking at here. So if you go back about 10 days ago, right, March 7th and 8th, Chairman Powell is testifying in front of Congress. And one of the questions they ask him is the stability of the banking system. And he says that the banking system, the risk in the banking system is moderate. It was moderate, meaning average. Like there's not, I'm not worried about the banking system.
Right. That was that day.
That was the 7th. And then I can't remember. It was like one day was in front of the House. The other day was in front of the Senate, and, but he had the same story both days. The very next day, Silicon Valley Bank fails.
Mm-hmm.
Okay. And everybody's been talking about that ever since. So Silicon Valley Bank fails on the Thursday, March 9th. Then we get this pretty hot jobs market on March 10th, on that Friday morning.
Are we going to talk about SVB more, or are you just go slinging past that?
I'm going to assume, honestly, at this point, we're going to talk about it some more, but
I just want to point out, it's one of the things
go ahead.
we were talking about when it happened. And I think this is going to be a common theme a little bit throughout most of these bullet points, which is some of these things were not a surprise if you were following them, right? And so, I tend to be a little bit more dialed into some of the tech stuff, and I've got friends that are out in Silicon Valley, and I used to be part owner of an internet service provider back in the 90s, so I got a little bit of an insight into that world, right? Not a lot, I'm definitely not, trying to portray myself as like hooked up in Silicon Valley or anything, but I tend to say like I would be watching that more. And so I say all that to say, Silicon Valley Bank has been, they self-identified. I forgot how far back. I want to say definitely within the last year, that they had some irregularities. That's the word they like to use with their accounting. Yep. And so that's always like, to me, it's always kind of laughable when I think, of all people that should know how to do accounting correctly, I would think a bank would.
Yeah.
Now, they're all businesses, and they all tend to fudge the numbers in, let's just call it creative accounting. Yeah. And turns out it was a little bit more creative than it should have been. They self-identified, mostly to keep anybody from going to jail. Yep. And so the reason why I'm saying this is, they already had some issues, right? And that anybody that was watching that would have already known, like, we're just waiting for it to be public, basically. Right. Now, it was a lot worse than I think most people thought. When I say that, I mean, investors reacted way worse than they thought they were going to, right? Yeah. They were worried about regulators. They weren't really worried about the investors.
Their depositors, right.
Right. Yeah. And it turns out they should have been worried about both.
Yes. So let's talk about Silicon Valley Bank a little bit. Silicon Valley Bank was the primary lender to VC money that funded startups. Okay, not only, there were like wineries and all kinds of things.
Tech startups, but
mostly tech startups.
Yeah. There were like little, like I read about this one company. This lady sold something online, right, which is very common nowadays. Sure. Like we have a friend of ours, she sells jewelry online, and she does well. She makes a living, and so this was kind of similar. She wasn't multi-millionaire. This is somebody but that was her bank, right? And so she freaked out, this lady. I was reading an article, not a friend. Yeah. But I was reading this article, and that was her bank, And of course, she's like, hey, this is not good, right? Right.
No, it's not good. And so the thing about Silicon Valley Bank is that, yes, it was a regular bank. You could go and use it as an individual person and make deposits there and have your checking account and all that. That was not their primary business model. Their business model was VC and startup money. And so for most local banks that take, our deposits, most of us don't have $250,000 in the bank, right?
Cash.
This is cash in the bank, right? So Silicon Valley Bank was taking deposits from companies, not individuals. There were some individuals, but it was primarily companies.
Yeah, mostly groups of individuals who had an LLC
right.
that were funding something.
An account, right? Funding an account. So there's
business accounts.
Right. Yeah. It ranges from like 30 billion on the high side. $30 billion in a bank account. in cash.
Crazy.
Yeah. So they were given a lot of perks and incentives, and I don't even want to get into the structure of how it got this way, but the bottom line is what every bank does, and this is what Silicon Valley Bank did. If you're a depositor in their bank, you get some ridiculously low interest rate, right? It's based on the short-term interest rate, and it's really low. We all know that. We get 0.25% or whatever on the money that you deposit in your checking account. It's like zero.
Mm.
The bank takes that money and buys treasury bonds with it, long-term treasury bonds. And long-term treasury bonds pay a much higher dividend yield than what the bank is paying you.
Mm-hmm. And so they're making money.
And so they make money that way, right? Until
oops. Oopsies.
Yeah, until the Fed starts raising rates,
Mm-hmm.
right? Because if you buy a bond for $100 at par, like the face value of the bond is $100. They call it par. Okay. If the yield goes up, the value of the bond goes down. Okay. So let's say the value of the bond goes down 20%. If you bought bonds last year, a 10-year bond, right? You're going to hold it to maturity, and you're going to get, if it's a 5% interest rate, you're going to get that 5% every year, and you're good, right?
And you're going to get your original money
and you
back.
get your original money back, right? So that's how they make their money. So they take your money in, they give you a little bit, they give you, say, 1%, they use that money to buy long-term treasury bonds, they're making 5%, so they're making 4%, right? That's all good. When the Fed raises rates and yields go up, the price of the bonds that you already bought goes down. Mm-hmm. So now the bond is worth, that you paid $100 for, is worth $80. Mm-hmm. Okay, that's fine too.
Unless you need the money.
Unless you need the money.
Yeah.
So all these people came in and they did what's called a run on the bank.
Yeah. I want my money back.
I want the money that I deposited, because I think that my money is actually staying in an account, which is not how the banking system works.
And most of the people that were doing this, they know that.
Of course they know.
These VCs and all these investors, they know that deal too. Yeah. So they knew what they were going to do to the bank by doing this.
Oh, for sure. Yeah, 100%. And Peter Thiel, when he put out that tweet, that did start this cascade, but he's not responsible for this whole thing falling out. But so the bank has these assets that are worth less, but it's no big deal because you're going to hold it to maturity, right? Mm-hmm. Unless there's a run on the bank. And so they have X amount of cash on hand to pay people, the depositors, out the money that they came to claim.
But not 100% of your money.
Right.
Of everyone's money.
Of everyone's money, right. So at that point, they have to start selling assets.
A Wonderful Life or whatever?
Yeah.
It's a Wonderful Life.
I don't remember if that's the movie, but yeah. So a big run on the bank, right? So now they have to sell these assets to pay the cash to the depositors, right? But they're underwater on the assets because they're down 20% in value. So they can't pay off all the depositors. And so they go to the Fed. And the Fed looks at the situation and goes, oh, the problem here is that the people that are that your depositors, quote unquote depositors, they're not people, they're companies, and those companies are making payroll next week on the money that you're supposed to have in the bank that you don't have, and now you have to sell these assets that aren't worth enough to cover what you owe.
Yep.
If we don't do something, half of Silicon Valley isn't getting paid next week. And so they jump through the hoops, and that's why by the end of the weekend, they sort of figure it out. So let's just go to the next day. Well, okay, so the next day is Silicon Valley Bank fails on the 9th of March. The next morning, we get this hot jobs report, which basically is inclining the market to think that the Fed's going to keep raising rates because the economy's getting stronger, it's not getting weaker, which is what the Fed wanted as it raises rates. And so there's a lot of talk on Friday about whether or not the Fed is going to be able to continue to raise rates. And that was, I put out a thing last weekend that the Fed's in a trick bag. So by the end of Friday, FDIC takes over Silicon Valley Bank and Signature Bank in New York for basically the same problem. Okay. Saturday, March 11th, Secretary Yellen comes out with a statement saying that there's not going to be a bailout of Silicon Valley Bank. Flat out, we're not doing a bailout. The next day, somebody must have talked some sense into her, because the next day, there's a joint statement between Treasury, which is Yellen, the Fed, and the FDIC, where they created this thing called Bank Term Funding Program, okay? BTFP. Not to be confused with buy the fucking dip, okay? Buy the freaking dip has been the mantra for how many years of our buy and holders are buy the dip,
Buy the
right?
dip.
Because that's just been the thing. And it might continue to be the thing because the Fed came out with this thing. Their term for this bailout is the ability for these banks to come to they call it the window, the Fed window, but this time they gave it the name Bank Term Funding Program. The big outstanding question about this is whether or not this window is open to Silicon Valley Bank, Signature Bank, and First
Republic?
First Republic, yeah. Those are the three big ones right now that we're kind of dealing with. And the Fed is in a blackout period, so they are not allowed to make any statements until the FOMC meeting, which is next, this coming Tuesday and Wednesday. So, okay, so that's the position. So by Sunday, they all get together and say, no, we don't want everybody not to make payroll, and so we're going to do something. So they come out and they backstop, and they say that all deposits, so FDIC insurance insures $250,000 per depositor per account, right? They come out and they say, we're going to backstop all the depositors for all the money. We're not going to fund the bank as a ticker symbol. We're not going to give the shareholders of the bank or the bondholders of the bank, we're not going to bail them out. But anybody who had deposits, anybody who had deposits is not me and you.
Right.
It's companies that had billions of dollars in one account, not 250,000. 90% of the deposits at Silicon Valley Bank were above the $250,000 limit. 90%. The infinite vast majority of that bank is well over what FDIC would ever insure. Okay? So all the powers that be say, no worries, we're going to backstop all that. And somehow they're trying to say it's not a bailout. Okay. That was on Sunday. Monday, March 13th, the president comes out, makes a statement about the banking sector and says, banks are great. Your money's safe here.
Everything's fine.
Everything's fine.
Move along.
Nothing to see here.
Nothing to see
right?
here.
At what, 9 o'clock?
This is not the droid you were looking for.
That's right. It was like 9 a.m, right before the market opens, right? All of this is to make sure that there's not a complete run on the banks on Monday, right?
Yeah.
Okay. So Tuesday, I mean, I swear to God, it's day by day, hour by hour.
Just bam, 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 bam.
Tuesday morning, the CPI comes out, which is one of the inflation reports, right? CPI, inflation had ticked down like 0.1% or whatever.
Consumer Price Index.
Consumer Price Index, yeah. It barely moved. So clearly the hikes that the Fed has done to this point are not bringing inflation down to the level that they need it down, right? The next day, the PPI, Producer Price Index, comes out. It does show a little bit more deflation in some of the different areas of producer index, but nothing major. Inflation is still clearly problem number one, okay? Also on the 15th, Credit Suisse Bank collapses. Why do we care about Credit Suisse? Silicon Valley Bank is a big deal if you are running a tech startup in the U.S., right? It's not going to cause bank contagion. Credit Suisse Bank is one of the biggest, most important banks in the world. It's like Lehman Brothers.
Right.
If Credit Suisse fails...
It's their version. It's a European version of Lehman Brothers, big bank, big four.
Big bank.
Yeah.
If they fail, there's a big worldwide banking problem, right? On the 16th, so the next day, Swiss Central Bank gives a ton of money, I can't even remember what it is right now, to rescue Credit Suisse, right?
It was just below a cubic butt ton.
Cubic.
Yeah. It was huge. The but that, again, I like to keep things in perspective. So that wouldn't be much different, from what our central bank would do here or has done, right? And so, it's probably a good thing that they stepped in and did that.
No, not uncoincidentally, they did it in conjunction with our Federal Reserve.
Right. There was 1,000%.
Yeah.
They're all the central banks across the world talk to each other as they should, because any one of them, could affect it. It's all connected. We're a global economy.
They
right?
don't just talk to each other. They're coordinated by
They're
a
absolutely
thing,
coordinated.
a thing called the BIZ, I'm drawing a blank on the
the acronym.
Bureau of International Settlements.
Yeah. They're all coordinated as they should be, right? It's global economy. We're not out here doing it by ourselves.
Right.
What I think is unique again, if you go back and you look at the last 6 months or year or so of Credit Suisse, again, if you're a banking analyst, none of this stuff was a surprise. No. There are people that literally this is all they do, right? Yeah. They analyze, they do analytics on the health of the banking industry, and when a bank is not doing their accounting properly, right? They're held accountable a little bit different than a regular company is, right?
Right. So honestly, the most, I don't know if it's egregious or as in terms of a mistake, or if it's just physics. when central banks around the world, which is what has been happening for the past year, central banks around the world have been raising rates. Okay, not just in the U.S. Inflation, because everybody's trying to fight inflation. Inflation in Europe is much worse than it is here. Everybody's been trying to fight inflation. They're all raising rates. When the premise of banking is that you loan at short-term rates so that you can buy at long-term rates, and that is your business model, right? If you're an investment bank, J.P. Morgan and those guys, they have different sources of income. Mm-hmm. But if you're a regular bank, local bank, or regional bank, commercial bank, that's how you make money. Mm-hmm. When the Fed starts raising rates, when the whole world starts raising rates,
you're screwed.
You are screwed. Like there's going to come a point where you can't. That business model doesn't work. It's not sustainable.
A sustainable business model.
And the Fed knows that, right? And that's always been, and we've been talking about it, and it's on everything I always hear all day, is that at some point the Fed's going to raise rates to the point that something breaks. And this is the beginning of, this is the first thing that broke.
What that is, yeah.
But it should not come as a surprise to anybody, because it's physics, it's math.
Yeah.
It's not, there are some, in the case of Silicon Valley Bank, they did some quirky things, but it's gonna happen, right? So
there's a lot of smart analysts that are going, hey, why was everybody surprised? Right. This isn't a secret, but it was from the general public, though. That's the problem.
Oh, yeah. Because we don't understand how it works.
Yeah, and that's what it comes down to, is just education, right? We're always talking about that's why we do this, and again, why are we talking about this? Because it impacts the market. Which impacts the TSP, and we should be educated in how we go about dealing with all of this, right? And does because this is the first question people would ask me, like, hey, I'm not in Silicon Valley, Conan. What impact does this have on my bank?
Sure,
right? And the answer is, it depends, right?
Yep.
Are you? I think we saw an article. I think I'm going to send it to you today about Truist, who had bought out BB&T, and it turns out they had a chunk, connected to Silicon Valley Bank. So your bank could, right? And so if it's outside of your most of us just have a checking account that we're paying our bills out of. We don't have $250,000 in that account. If you do, God bless you. You're probably not listening to this podcast.
Hopefully not.
Yeah. And so does it impact you? Probably not, right? Your bank's not going to go under.
Well, it probably won't affect you. It could affect your bank. So I wrote in the newsletter this weekend.
Does it affect you personally? Probably not.
No, because you have FDIC insurance.
Right, and you don't have over $250,000 in there, so you're probably good. Does it affect your bank? Does it affect your? I was telling Jerry, some of my family members from way back in the day had huge investments in BB&T. So if that was to play out today, then maybe yes, that would be an impact in a lot bigger impact than just my checking account, right? Yep. And so it just depends on what relationship you have with the bank and what you've got going on with the bank. And there's a lot of people right now that are kind of I feel like there's a negative sentiment to regional banks now. And I've always felt that I would rather do business with a regional bank because I want to know the people,
Yep.
right? The problem is you think you know them because they're people, right? And you think, oh, I know who the president of that bank is.
Right.
I know who runs Lehman Brothers or J.P. Morgan, whatever. I know all these, but I don't really know them, right? I know who they are. But anyway, but the problem is like, do you really know your bank? Do you really know what they're investing in? Do you really know what their business model is? And that's the important thing. And so if you're going to deal with a regional bank, you better know more than just who the vice president of the bank that sits at your bank. You know what I mean?
Right.
Because I know a lot of small business people like in rural Arkansas and Texas and places like that. That's who they deal with,
Yep.
right? We've got a lot of regional banks around here in Northern Virginia. Anyway.
Yeah. No, you're 100% right.
I just don't think it's fair to beat up on all regional banks, but you do need to know a little bit more about what your bank is doing than you might think you do.
The way any bank that's not a J.P. Morgan investment bank, I can't think of any right now, but there are there are a handful of others that are big investment banks. That's where all the money now is running to, because the fear in regional banks is pushing all the depositors to the J.P. Morgans of the world, right?
Particularly if you're an investor.
Right,
And,
that level, not individual people, that level.
And I've always had an argument that I like my investment banks and my commercial banks to be separate.
Yeah.
And they were for a long time.
Right, they're supposedly
and now
they
they're
are.
kind of back into the whole gray area thing. And it really just depends on what they're doing. If you're a regional bank that's primarily commercial, right? So you deal with people like us, normal people, maybe a few small businesses or whatever. But now you start to get into this investment realm where you're trying to make a little money.
Yeah.
The bank is, not for you.
Right, no, the bank. Right.
The bank's trying to be profitable.
So the biggest, my opinion, the biggest going forward concern with regional banks is their exposure to commercial real estate.
Yeah.
Because if you're building local shopping malls and condo complexes and all that,
if a large part of your portfolio is that,
you're getting funded by those regional banks.
Yeah.
And if the regional bank's portfolio is commercial real estate, which right now the occupancy rate is like ridiculously low, right? Because nobody wants to go to work, and this has been ongoing since COVID because no one's going back to work.
This isn't new.
Right. So
that's something to take a look at. If your regional bank is over, look at their whole portfolio. If a significant piece of their business portfolio is investing in commercial real estate, you might have a problem, especially if you have a small business or a side gig or whatever it is you're doing, and that's your bank. You might want to get educated.
As long as you're under 250, FDIC is going to insure you, and you're fine in your account. But it'll be a hassle if your bank fails. You're not going to have access to the money anytime soon.
Yeah, but we know small businesses that basically use, I don't want to call them regional banks, but I mean, that's kind of where they fall, and that where they use these institutions to make payroll. It's very similar to what Silicon Valley was
doing. It's what we do with TD Ameritrade.
Right.
I mean, TD Bank, right? It's everybody has to put their money somewhere that they need to use to pay payroll or business expenses or whatever it is. And there's no way around that. It's just that now you want to minimize the amount that you have in those banks for those transactions that you have to have on a daily basis. Yeah.
So back to the timeline.
Okay.
We
can keep going with this thing. Yeah. So okay.
We left off at Credit Suisse.
Credit Suisse collapses on March 15th. The 16th was a Thursday. Swiss Central Bank injects a bunch of money into Credit Suisse, and then that was in Zurich, and then back to the U.S. on the same day. First Republic Bank gets bailed out by 11 major banks. So these 11 major banks were like Wachovia. It was Wachovia. What's the other one that begins with a W? Wells Fargo.
Wells Fargo,
J.P. Morgan, Citicorp, like all these big institutions come together at the behest of the Fed, because the Fed doesn't want to do another separate bailout and all that because it just got done, right? So they get with Jamie Dimon personally, and they're like, bro, you got to figure something out here. And he gets his other 10 buddies together, and they bail out First Republic Bank. The 17th, I was doing St. Patrick's Day, so I have no idea what happened on that day. No. So nothing really happened on Friday. Nothing,
Funny,
at least in terms of
funny
this.
how that worked out.
Yeah. So now we're into this weekend, right? Now we're in yesterday, so Saturday. UBS. The big question is UBS going to buy Credit Suisse, right? If UBS does not buy Credit Suisse this weekend, then the world banking system collapses, right? That's why I'm saying if UBS does not buy Credit Suisse, then Monday is going to be a very big day. It's going to be a 2008 waterfall collapse day, okay? Today is Sunday. It is right now 5 o'clock, and we got to hurry up because we got to get this thing up by 6:30.
We're on the first slide, man. We're on the first slide.
We're gonna hurry up. As of 1:30 this afternoon, I'm gonna just read this off of a Wall Street Journal thing. UBS agrees to buy Credit Suisse for more than $3 billion. It was $3.2 billion. The deal, a substantial discount to Credit Suisse's $8 billion market value as of Friday's market close. So UBS is buying Credit Suisse for $3.2 billion on an $8 billion market cap. Was engineered by Swiss regulators and is designed to restore trust in the banking system. It's the first takeover of a globally important bank since the 2008 financial crisis, from Wall Street Journal. So we are on the precipice of all the stuff that was going on in 2008. Mm-hmm. Does that mean that everything's going to crash, and blah, blah? No, it doesn't mean.
There's a lot of folks saying this is nothing like 2008. And you go, I don't know, were you around in 2008? Because I was, and it's getting pretty close. It's not the same.
It's not the same. It doesn't repeat, it rhymes. It is the same.
Yeah. It's not the exact same.
It's not the exact same, but it's the same problems. Debt is the problem, and it's just poking its head up in a very, very little bit different way. Mm-hmm. But it's almost the same. It's not residential real estate. It's going to be commercial real estate next, and it's the banks first. And So if you're in the CNS, buy and hold right now, and I don't know what to tell you.
You might want to rethink.
You might want to rethink your strategy. All right. So that is Saturday. Sunday. Sunday as of today at 1:30 this afternoon. Everything is good. It looks like because the UBS, at the behest of Swiss government, Swiss central bank, and U.S. central bank, because they have absolutely been coordinating about this. And this is not me making it up. It's in all the financial press. They came to a deal to save Credit Suisse. So now we have to wait. Monday, who knows what's going to happen. Tuesday begins the FOMC meetings, and then Wednesday we get the next Fed rate announcement. The vast majority of analysts think that we get a 25 basis point increase on Tuesday. So what that basically does is it acknowledges that inflation is still our number one problem, but they're in the press conference, you can be sure that Powell is going to acknowledge that, yes, we have this banking snafu going on, and we're looking at it, and we've already done some things last weekend, and we're going to keep an eye on it, and we're going to do whatever's necessary to make sure that the banking system doesn't collapse. So it's going to throw a bone basically to the banks and the market, and it's going to, he's raising a quarter point.
Is that what your crystal ball's telling you?
Yes, that's my crystal ball. Yeah. That's my crystal ball. And because if he does anything else, if he pauses, right? So here's the idea of if he pauses.
It's a slippery slope if you pause.
If he pauses, one argument is the market takes off, right? Because the Fed is pivoting, and we've all been talking about for so long how when the Fed pivots, the market's going to take off, right? No. If the Fed pauses here,
there's still a lot of fear out there.
They're fearful. They're saying, "Oh no, there's something big going on here," and not only are we not raising, we're actually thinking about cutting rates, but we're just going to pause here just to get our bearings.
Fear will skyrocket.
Yeah,
and more uncertainty. I wouldn't say just fear. It's going to be mostly uncertainty, because that doesn't give us anything to work with if we just pause. Right.
Right. Pausing is basically a cut, and it will be interpreted as the Fed sees something really wrong that we don't see, right. and the market crashes. Yeah. Right. If 2 weeks ago, the estimate was like 70% that the Fed raises 50 basis points. because inflation from the CPI and PPI,
But it's not going to be as high. I mean, we'll see. You know what's it's not funny, but I say funny, but it's interesting is a better way to say it. I mean, we're in some interesting times,
Yeah,
right?
for sure.
Because if you went back a year, if you went back 6 months, no one publicly, right? No one publicly was talking about this. No one saw it coming. I think some people saw it coming.
Yeah, it's physics. It was coming.
Yeah. What I think is interesting about things like this is when analysts at a higher level than we are, I mean, really, their job is to see this stuff coming, right? And that they're telling people, they're talking about it, but the narrative gets pushed down, right? Oh. Because the narrative,
it's not politically palatable.
The narrative, it drives everything, right? Yep. And once the narrative shifts, something happens at one bank and then another bank. The people that are in control of the narrative, and there's no conspiracy theory thing. I'm just telling you that, this is the way it works, right? Where the overarching narrative that's at any given time. And I was telling Jerry about this, when this first started happening, my public affairs brain kind of tickled because I was like, oh, if there's any banks in trouble right now, they're going to come out publicly because now's the time to do it because it's not just you, right? So if you're a bank in trouble right now, regardless of what size bank, and you've got issues and they're going to come out, you didn't want them to come out because it would be just you. Now everybody's, so now you just jump in there and you get lost in the narrative. So it's not all about so-and-so bank, right? And so I don't think we've seen all of them. I think there's more waiting to kind of, and they're just like, well, let's just seep it in a little bit at a time, right? And it's like, let's not talk about that today. Let's talk about that on Thursday, right?
We need a slow news day. Yeah.
It's gonna be a wild week. I know that. So let's get through this.
We need to get past it because there's so much more we could hang. There's a lot of stuff that's
could
still flailing around in my brain about this.
When you put this up there, I was like, is this the whole podcast? Because we can talk about this whole.
I know
you got other stuff. You might have to skip a couple things, brother.
I'm gonna go quick for the rest of it because we've already been going for 40 minutes. All right, so completely switching gears, trend lines and relative strength. Right. So forget about all the politics and economics and bank failures and the rest of it. It's gonna show you in price action. And so how do we kind of get our brains around it in terms of TSP? Trend lines are a really good way to do it. So as always, Investopedia, trend lines are easily recognizable lines you can draw on a chart to connect a series of prices together to show some data's best fit. Basically a trend, right? A trend line is drawn over pivot highs or under pivot lows, and it shows the prevailing direction of price, right? The trend. Trend lines are a visual representation of support and resistance in any time frame. They show direction and speed of price and also describe patterns during periods of price correction. So you can get a lot of information from just drawing a simple trend line, and it's basically you're drawing it by your eye, all right? So if we're looking at this chart, the price goes up and down, and, you can see that overall it's coming down here and overall it's going up here, but how do we really get our mind around how this works? So here's a 3+ year daily chart of the C fund. We're going back to the COVID low. And once the market got moving, after the COVID low, we get an initial run up, we have a little consolidation, and then we get another move higher. So that little initial consolidation gives us our first point of reference. Market's going, it does a correction here, right? And then moves higher. That gives us our second point of reference. Okay? And then the price keeps going higher, comes down, gives us our third point of reference. So now we get 3 very solid points, and we can just extend that line out to forever, right? But we know that since it found support at these, 3 areas, if it, and that was over the course of, a year or more, if it breaks that trend line, the trend is broken, right? It's called a trend line for a reason. So the trend is broken when something happens, when that line is broken. And that happened this, week or day, whatever, in January 2022, right? So this break in the trend line in and of itself doesn't necessarily mean you have to bail out of the stock funds, because you could connect the line. I mean, in this case, it's kind of tough to do because this is really the only trend line we can kind of draw. But since this high was lower than this high, you don't have, this is, if you drew that trend line, there's nothing to connect it to, right? So that's clearly not the trend. The trend is the significant bottoms over some amount of time, and it broke right there. There's no doubt about it, right? So when you're in an uptrend, you're connecting the lows. When you're in a downtrend, you're connecting the highs, and it's the exact same thing. We have a high here that's lower than this high, so that's a problem. Then we have a lower low. That's not good. Then we come up and we have a lower high. Now we have 3 points to connect on the downside, so we can just keep extending that line down, right? And then what happens? We come up, we hit it again, it rolls over, okay, but it doesn't put in a lower low, right? It puts in a higher low. And here we broke above that trend line, right? That was in January 2023. It was the first time in a year that we had gotten above that trend line. All that means is now there's a possibility, just a possibility that price can continue higher. Because until it breaks that trend line, it cannot continue higher, okay? It doesn't guarantee anything. It just means it's possible now. So unfortunately, in this case, it rolled back over. But we also have a shorter term trend line. So we have a low in October, we have a low in December, and if we connect those lows and we get a third low right here, that would have been great. If we had gotten support there and kept on moving higher, this trend line can keep going, price keeps moving higher, everything's great. But that's not what happened. We got to break below that trend line, okay? So that's a long-term chart, and that's basically how we'd look at it. If we drill in a little bit to a shorter-term chart, so now we're looking at, here's the top in 2022. This is the same trend line we were looking at before. That's where it broke. And now we're connecting these tops, and the line keeps going down. We get the breakout right there. The market comes up, rolls over, and now you're looking for support at that trend line right there, okay? Because you want that to be 1, 2, 3, 4, 5. You want this trend line, which is now very well established. You want this to be the first support level of this new uptrending trend line, right? That's what you want to see. We didn't get that. Okay, we got a huge breakdown through that trend line right there. Can it turn back around and come up? Yeah, it's possible. It doesn't mean the market's going to keep going down like this, but the trend is no longer in this direction. Right? Does that make sense?
Makes sense to me.
Yeah. I mean, these aren't like timing tools. They're general like concepts. It's the direction that the market's going. Right?
Yeah, well, I mean, I think, like we always say with this stuff, right? This is one tool, right? So if you have, if you have price, volume, RSI, MACD,
yep,
right? That's our stack,
yep,
right? And we're looking at that, and then you draw trend lines. You've got a lot of information there,
yep,
right? You've got a lot of data that can tell you, first and foremost, like I love trend lines because it goes to our principle of, if there's a trend change, right, a significant trend change, if it's a downward change, we're in the G fund.
Yeah.
If it's an upward trend change, we're going to be in the stock funds,
yeah,
right? And sometimes we spread it across the stock funds, yep, CS&I, and other times we're more CNS, right? So you gotta be looking at all three of them, obviously. But generally speaking, if that's all you do,
yep,
you're going to be on the right side of the market for decades.
Yep.
Right? And that's not a lot of movement.
Nope.
If you just did that, right? Now, as you look at that chart, let me get back on the chart. Like Jerry just did a minute ago, you can zoom in and out, and you should, right, for different time frames. So that if you're looking at this on a weekly basis, right? So I always tend to say, like, start here. Right, so you're looking at a weekly basis,
yep,
zoom back out,
yep,
take a look, zoom back in.
Yep.
And you should have a good view of where you need to be.
Right.
And if you take those principles alone, you're 1,000 steps past where most people are when it comes to managing your. And I would say this, like your retirement account in general, IRA, 401k, TSP, whatever it is you have, right? If this is how you manage it, you're gonna fare well over the long term. Again, you're not day trading,
right?
This is not about that. This is about being on the right side of the market,
right,
which is our fundamental methodology.
Yep.
Do we look at a bunch of other things? Absolutely. Why? Because people are paying us to do it.
Right.
But if it's just you out there and you want to do it yourself, that's it. I mean, what Jerry just showed you with trend lines is I know people that just trade based off of that.
Absolutely, you can trade up just based off that.
Yeah,
absolutely,
and that makes life very simple.
Yep.
Now, if you want to be, if you want to, like Jerry said, time it a little better, right? So maybe get in a little faster, get out a little faster. You're going to need more data points.
Right. We're actually going to get to that.
All right, go for it.
All right. Not a whole lot more, but a little bit more.
Because we're going for about an hour and a half.
Yeah.
So far.
No, we got to
Just
go.
kidding.
All right. So, this chart, we got 1, 2 long. I'm going to call them long-term trend lines, and 1 short-term trend line because it began at the October low. And we only had two points to connect. It would have been great if this was a third one, but it failed. But this one was a relatively short trend line. You can so now you might say, well, what about these rallies, right? I wanted to get in on these rallies because those are the only chances I was going to have in 2022 to make any money. First of all, there's the noon rule and the 2 move a month rule. So that makes it about impossible to catch this rally. You might get a little bit of this, and if you didn't get whipsawed by this, then you might have gotten some of that rally. But it's just very, very hard given the restrictions that we have. But we have a lot of people that say, well, I want to look at it on a shorter term basis. So you can drill this down and say, okay, here's a trend. I'm connecting the tops because I have a top here, a top here, a top here, and when it broke, I'm going to buy it. Yep, you can buy it right there. It keeps going up. Now you got to figure out when you're going to sell it because now you're in a downtrend. It broke out of it here, right? Came down, tested, and we had a nice rally there. And now you would have to figure out why would you get out at that point? But now you have 1, 2, 3. So if you connected these lines, you could say, okay, I'm getting out because I had drawn that trend line. If it blew through there, if you had this trend line and you were here and you had gotten, back here somewhere, you might say, all right, I'm going to stay in with the expectation that it's going to keep going higher. If it breaks this downtrend line, I'm going to get out, right? So as you decrease the time, you can draw trend lines on any time frame. And as you decrease them, you're going to get closer to the best gains and the least losses. But we only have 2 moves a month. So it gets very tricky. So that's the trick of this game is finding the sweet spot. Okay, that's trend lines. I think that's a pretty good overview for trend lines. So the one thing I wanted to add to trend lines is relative strength because this is my favorite indicator. So relative strength is a momentum indicator. Okay, it's momentum. It measures the speed and magnitude of securities' recent price. Okay. Momentum indicator measures the speed and magnitude of the security's recent price. That's all we got to know about that. Okay? So let's flip to a chart of the COVID collapse. So here's the C fund going into COVID. Okay? This is the RSI, the relative strength indicator. Okay? This is my favorite, really my favorite technical analysis tool. I look at a lot of different tools, but this is the best one.
Is this a leading indicator?
Yeah.
Right. It's giving you some insight into where we're headed.
What's going to happen in the future.
And that's very useful.
Yep.
Right?
Right.
Very
Now,
useful.
it calls significant, it calls significant tops and bottoms really well. You can do it on any time frame, but on relatively significant tops and bottoms, it works really well. So we gotta speed this thing up. You can see price is going up. as we're going into early, 2020, right? So COVID was what, March 2020. So here we are, prices moving higher into the end of 2019 into 2020. But the relative strength is declining even as price is increasing, okay? So when this high was lower than this high, even though price is continuing to move higher, that's the divergence, okay? This is going lower, this is going higher. It's telling you that the momentum behind this price move is waning, it's decreasing, okay? And then we get this little blip right here, right, which was this in RSI. And when we came out of it to new highs, we were way, way below the new high in RSI, right? Way, way below it. I mean, okay, so you should have been on guard. It has nothing to do with COVID, nothing
Right.
to do with anything. But
And we were on guard.
and we were.
That's why we were out.
we were out. We actually got out on that day right there.
Yeah, yes.
And if you don't believe us, it's the alert came out that day. It's on the website. Okay, so that's all I'm saying. And so in reverse, what happens? We have an initial collapse in COVID, which was the first few weeks, right? Days. I'm sorry, a couple days. COVID was like a 4-week event, but in the first couple days, it collapses really big, and relative strength gets down here to way negative, right? Then we get a little recovery rally, which took us back up to the moving average of the RSI, and then the collapse continues down, right? A huge price move down, but relative strength does not come down to make new lows. So we get price making huge new lows, but relative strength is not making new lows, which means that this price movement, the momentum in this price movement is not that big. So if you're watching it, you're looking at it and you're going, okay, I'm not getting in now because price is collapsing, but I am seeing that the relative strength of that collapse is not that bad.
The momentum's slowing down.
Momentum's slowing down. The momentum of the selling is slowing down, right? So now you're on alert. Hey, I'm looking for when I'm going to get back in. So, I mean, this low, this is a higher low, this is a higher low, and then we get above the moving average of RSI, and that was on that day.
Bingo.
I mean, there's still some risk there, don't get me wrong, and this is only one indicator, RSI, but it's a really, really good indicator. All right, that's COVID. And if we go to the top in 2022, you see the same thing. You got way overvalued RSI up here. Price corrects, or RSI corrects along with price. And then as price comes up and makes, this is like basically a double top, higher low, which is good. So the trend is still up. Now we get a higher high, we get new high prices, but we get relative strength declining. Relative strength is declining as price is going up. At the top, right before the top in January 2022, right? That's the day that RSI gets down to 50, and we keep talking about how when RSI gets to 50 and price gets below the 20-day moving average line, that's the day to get out, and that's why, right? All these indicators are lining up together. This was a great setup. We had plenty of advanced warning, not timing to the day, but warning that the rally was fading going into the top, going into January 2022. Okay. And then if you combined the relative strength with the trend lines, right? Only two indicators we're looking at. Okay. So in this case, I did, this is the COVID, back to COVID again. So you could say, all right, I'm going to draw a trend line and I'm going to connect these lows and I'm going to extend it out. And when you extend it out, that's where you get, okay? And then on a shorter term, I'm going to take this low and connect some of these recent lows and extend that out. So in COVID, on this one day, it gapped down and went through that short-term trend line, okay? And if you were looking at RSI was already rolling over. So I'm looking at RSI, anticipating a top. The market gaps down through that first short-term trend line. I mean, if you're not getting out on that day, I don't know. You're not paying attention to the analysis, is what it is. So you say, okay, I missed that gap down. I'm going to hold until this trend line, right? Because now if it breaks that trend line, then maybe something serious is going on. So it breaks that trend line on that day right there. RSI is absolutely collapsing. That's your last best chance to get out. We have a little recovery rally back to that trend line, and it turns back over and goes down. So that's how you would combine. RSI isn't a great timing tool, like we said. It's giving you fair warning as RSI decreases and price increases. It's giving you warning that it's getting ready to roll over. But in terms of timing, once it can keep going along this trend line, and that's great. It can keep going for a long time. And RSI can keep going down. The top can keep going. But once it breaks that trend line, you got to get out. And that's where we were at. So that's COVID, using just trend lines and RSI. Top in January 2022, same exact thing. We connected the trend lines. On that day, it clearly broke a pretty long-term trend line, right? We showed that, it goes back to however far back it goes. It was January 6th, I think, was that day right there. RSI had been falling off, right? Particularly this one. This, I mean, it was kind of a no-brainer if you were there and you were actually looking at it. Once on that day, we got below that trend line, and RSI was headed down. There was no reason to hope the stock funds were gonna rally back from that point. All right, that's it for trend lines and RSI.
Good stuff.
And, yeah, good stuff, right?
You might chop that out and put it in its own video.
Yeah, you might see that again. All right. Oh, I forgot we have a lot more to go. C-Fund Daily. So
now Jerry's on a
he's on a sprint. I thought we were going to the regular stock funds, and we're not.
Oh no, you still got the bonus chart, bro.
Golly. All right. I
stretch.
Yeah, stretch. I hope
you want me to sit over here and stretch for you?
Well, I hope she appreciates the request for TLT. Okay, so here we are before we get to TLT. This is what we put up last week on the C-Fund, right? We have been talking about how the support zone was between 39.30 and 39.80, and that support zone failed last week. So now that support zone, it failed on that day. That was the Thursday last week when we recorded the show, and it broke through, and it actually closed. If you can see, I'll zoom in here in a second. You can see that on Thursday, it closed below the 50-day moving average line and below the 200-day moving average line and below that upsloping trend line. So all the support failed on that day. That was the last best chance to get, and I think I said it last week on the show, that was your last best chance to get out in terms of this short-term trend. Okay, it doesn't mean that the market's going to collapse. It just means that the trend has changed at that point. And that's your last best chance to get out. Because if the market does go that way, that's your last best chance. Okay. So if we fast forward to close on Friday, that was the collapse day. The market continued lower into Monday, rallied, right? And then into Friday, and then rolled over on Friday. And so if you're a subscriber to the site, the newsletter that's coming out tonight goes into excruciating detail about this time period right here in 15-minute increments and why the market rolled over literally exactly to the tick that we anticipated that it was going to roll over. That doesn't happen all the time, but I spent a lot of time this week on the 15-minute charts of the S&P 500 because what I was looking for was We had a break through all that support and that downtrend line. I'm looking for a rally to retest that support, and then I'm expecting the market to tank, right? So I'm looking for how high are we going to rally? Where do I expect the market to roll over? And hopefully people, subscribers, kind of appreciate the detail of those 15-minute charts that we put up. We definitely show you how to do it. Okay. And of course, RSI is tanking, and so there's no point in being in the stock funds at this point. TLT. So TLT is the long-term. It's like the F fund, but there are no corporate bonds in it. It's the long-term Treasury ETF, right? So when it's the 20+ year Treasury ETF. So when yield goes down, the value of TLT goes up. Okay, so it's not directly related to when the Fed raises rates. It's what the market thinks. The market is driving TLT. It's not the Fed funds rate. So if we're looking at the chart, and this kind of goes to why I had a lot of people asking, why didn't we get an alert to go into the F fund? And here's why. We are in this rectangular consolidation right now. Okay. It's pretty well established. I mean, you have two solid parallels on the bottom, and at this point 3 on the top. So it's a well-established horizontal channel. Until it breaks one way or the other, you're guessing. There was a buy trigger that happened. Can't really see it, but we put it out on a market update last week to subscribers. A buy trigger happened on that gap up, but I didn't reallocate to the F fund at that point because I'm not. It's overbought in the short term. And B, I'm not convinced that we actually do break above that 110 level. And right now we're in this horizontal consolidation. All right, that's kind of the short-term view. The long-term view is that here we are at the top. Here's a couple of possible Elliott wave counts. 1, 2, 3, 4, 5. Okay. Another one could be 1, 2, 3, 4, 5. 1 ABC for 2, 3, 4, 5. Okay, so it's possible that this is a significant bottom, that this is a 5. My problem with that count is that 1, 2, 3, 4. The 4 is very short relative to the 2. Okay, the 4 and the 2 should be relatively symmetric. And so I don't like 1, 2, 3, 4, 5. I don't like that as an Elliott wave count. And I think, I honestly don't like this either, but if you said 1, 2, 3, 4, 5, so it would be 1, 2, 1, 2, 3, 4, 5 for 3, A, B, C, D, E for 4, and then 5. I like that better. But honestly, neither one of them are great, and so I have. I'm not convinced that this is a low and this is the first leg ABC and we go higher. I'm not convinced of that yet. It can definitely happen, and what it's going to come down to is what the Fed does on Wednesday. If the Fed continues to hike rates, then we're likely to see this roll back over. If the Fed pauses or gives enough indication that it's going to pause in the future, then it's likely that we move higher from here. But until we break out of this horizontal consolidation, I'm not willing to pick a side. So that's kind of it for TLT and the F fund as well. All right, TSP fund charts. This is the one we do all the time. It's very similar to what we've been talking about. This is the blue line is the 20-week moving average line. This is a 3.5 or so year chart where each of these ticks is 1 week of price action. And the blue line is the 20-week moving average line. So it's a moving average as opposed to a trend line, but they're both kind of similar. Once we got back above that 20-week moving average line, we got support every time we corrected, right? Until this week in January, where we had a trend change. And then that 20-week moving average line acted as resistance. We had a couple of overshoots. We had this nice rally off of October, correction into the beginning of the year, and now we are back below the 20-week moving average line. So the only reason I keep harping on that 20-week moving average line, it's not a timing tool. Again, until price gets above the 20-week moving average line, right, which will turn the curve of the line up, until we get there, we cannot have a sustained rally. So it's not like just because we're above it, right, we're going to get a rally. It's just that if it's not above it, we can't have a rally. And so here we are. It was a positive week for the C fund, but it came up to that. If I zoom in, I'm pretty sure you can see it. You see the wick at the top hit that 20-week moving average line and rolled right back down.
It's just not ready.
It's not there yet.
It's not ready.
It could happen on Monday, or next week if it's a weekly chart, but it's not there yet. And you got RSI below 50 and MACD just barely above 0, but it's clearly crossing to the downside. So they are in the C fund. S fund is weaker than the C fund. Last week we had a big, like 8-something% drop, closed clearly below that 20-week moving average line, and then a continued decline of 1.71% this week. RSI significantly below 50, MACD crossed negative. No reason to be in the S fund. I fund had the strongest rally off the October low. It's rolled over. This week was bad because Credit Suisse took a big chunk of the I fund. It closed below its 20-week moving average line for the first time since breaking above it back here on that breakout. We're now below 50 RSI, and MACD is just about to actually, it is negative in terms of the histogram, but I fund is not the place you want to be right now either. And as we've been talking about, the F fund is the most interesting chart. We got above that 20-week moving average line back here. It looks pretty similar, not exactly the same as TLT, but kind of similar. This week that we just had is pretty important. We came down intraday, tagged that 20-week moving average line, and then rocketed back up and closed at the top of pretty close to the top of the trading range. So it's a very bullish candle, what we're looking at here this week. It's not above 100. So you can see since back in the beginning of December is really that first wick that was poking up there close to 100. Ever since then, we have not closed above 100 since, I hate that I can't write on it like this, but here's 100. The last time we were at 100 was back here in August 2022. So we can't, this is a huge resistance level for the F fund, right? If it gets above that level, it's game on.
It's also important to remember that in the F fund, another reason why we wouldn't be so quick to jump in is because the F fund doesn't, the gains aren't as strong in the F fund as they would be in the C and S, right? So if we jumped in there, it's not like you're going to get these massive gains like you would in the C and S and I. So again, we're going to wait till there's this long-term trend change that maybe the F fund is a good place for us, like it was back in, I always get this
2018.
wrong. Yeah, I want to say 2008. That's not the year. Yeah. 2018. We've been doing this too long when you mess up a decade.
Yeah.
2018, which was a good year for us, and it was mostly F fund related.
Yep. So last thing about the F fund, big reversal candle, RSI back above 50, and MACD cross positive. So, if you wanna get in the F fund, there's nothing wrong with that. It's just that until it gets closes above that 100 level, there's still risk. And this week, you very well may see the resolution of that. So the thesis has been, we've been talking about it for months, close to a year. If the Fed raises rates until something breaks, the stock market crashes, investors flee to the safety of bonds. Stocks go down, F fund goes up. We've been waiting for that split for a long time. And we might have it this week. We don't have it right now, but we might have it going into this week. We might not. Because the other side of that is, if, as everybody's been saying, if the Fed pauses or decreases rates, a while ago we were saying that would scare everybody because they think that the Fed knows something that they don't know, and so the market tanks. That's one possibility. The other possibility is that what everybody's been saying for the past year, when the Fed pivots, the market's going to take off, and that could happen too. So that's why I'm saying right now it is a incredibly dangerous time to be an investor. Period. And if you're in TSP, the G fund is without a doubt the best place that you can hang out and watch all this chaos.
And with that,
questions. Yeah.
If you have any questions, hit us up in the comment section wherever you find this video. If you don't find a comment section, then hit us up at support@growmytsp.com. The support team will send it our way. We hope you guys got a lot out of this show. It was a little longer than normal. It's actually not too long. But we did like to talk about the banking crisis that's going on because it's top of the news and top of a lot of people's anxiety levels, and so
it's not going to get any better anytime soon.
Yeah, and I'm usually an optimist, right? Jerry knows this.
Yes,
but I see more of the same coming, and I'm not a genius, but you can see other analysts kind of saying the same thing. We're on this path. So the good thing is you're watching this show. Stay educated. Stay engaged. Don't listen to everything you hear on Bloomberg and Yahoo Finance and things like that, because they just have time to fill. So a lot of times it's skies falling, or they're just kind of the same narrative again and again and again. Yeah. Get out there, do a little research, do some Googling, find out what's going on across the board. But if you're in the TSP and you want to find out where that's going each week, here's the place you need to be. I mean, nobody else is going to talk about how the market is impacting the TSP funds.
If you are watching the show every week and that's the extent to which you want to really watch your TSP account, you should be in the G fund for the foreseeable future.
Yeah. Amen. All right. Hope you guys have a great week, and we will see you
out of here
next week. I hope.
No.